Right, good day learners. In this lesson today I'm going to look at depreciation, what it is, why we do it, and the different types of depreciation we have. Now basically let's take an asset, and I've taken an example of a tractor here, but it would apply to a vehicle, to any equipment or anything. And let's say that I bought this for 100,000. Now that would be an asset to me. And its historical cost is 100,000. But as this tractor or any vehicle gets used, it loses value. If you go to buy a second-hand vehicle, you will find that the amount that you have to pay will be a lot less than what it was when you first bought it. And the price will get lower and lower the older it gets. And so as this tractor gets used up, part of it gets used, it gets wear and tear on it. And what we do is we're converting that asset there into an expense, the part that's gone, that's used up. So if you, for example, buy something for 100,000, but you can only sell it for 60,000, it's used up, it's lost value for a difference of 40,000. Now that amount that it loses is what we call depreciation. It's the amount an asset loses every year. Now if we expect this tractor to last for a period of 5 years, we take 100,000 and divide it by 5. What we're going to say is in year 1, the vehicle will lose 20,000. In year 2, the vehicle will use another 20,000. And so it will go on for the full 5 years, until at the end of 5 years now, remember it's now lost 80,000. When we get to the end of year 5, we don't write off 20,000 because then it would be worth nothing. The original 100 minus 5 times 20 would be 100,000, so it would be worth nothing. And so in the last year, we write off an amount of 19,999. That means the asset stays in your books with a value then of 1 rand. So what we've done is over a period of time, we've written off the asset, we've depreciated it, and we've converted it into an expense. Now the method that I've used here, where I've had a fixed amount, I took the 100,000 divided by 5 years and I got 20,000 per year. That is what we call the cost method, or the fixed installment method. It's fixed. Every year a fixed amount of 20,000. Now that 20,000 would be the same as saying we're writing off 20% per annum. 20% of 100,000 would be 20,000 every year until the last year when you keep it at 1 rand. So that is our cost method that we use. The other method is we use the diminishing balance, and as the word says, diminishing or reducing, the value of the asset goes down. So if we say the same thing, let's say we're going 20% per annum, so we're using the same principle as what we did in the cost method, and we're reducing that same asset. In the first year we'd still write off 20,000. The accumulated, the total depreciation from the day you bought it till now would still be 20,000 because you've only had 1 year. And the book value. The book value is what the asset is worth in your books. And that would be your cost minus your accumulated depreciation. So 100,000 minus 20, and it would be worth 80,000 rand. Now under the diminishing balance method, when you come to year 2, it's 20%, but it's on the diminished balance or the book value. And your book value at the end of year 1 was 80,000. So you work out 20% of 80,000, and so the depreciation is 16,000. It's reducing. The amount will become less every year. The total depreciation, the 20,000 plus the 16 gives you 36,000. And the book value cost, the 100,000 minus 36,000, and it's now worth 64,000. So although the asset is losing value, it's losing it at a reducing balance. We go on to year 3 and we'd work out depreciation 20% on 64,000. And so the depreciation now is reducing. It gets down to 12,800. Added on to the 36, so it's in total been depreciated by 48,800. And the value, cost, minus your accumulated, 51,200. And so you would go on for the next 2 years. Always 20% of the book value. So in year 4, it was 20% of 51,200, and that reduces your book value down to 40,960. Year 5, 20% of that, 8,192, and it's worth 32,768. Now this asset would continue depreciating, would continue on for as long as you had the asset or as long as there's value. But I just want you to stop and now have a look. Under the cost method, at the end of 5 years, we had written off everything except R1. So in your books, it was worth R1. Whereas on the diminishing balance, it's worth 32,768. And that makes quite a big difference. In many respects, the diminishing balance is the more realistic figure. An asset loses its greatest value in year 1, and then it keeps losing value, but at a reducing rate. If you look here, the amount it's losing is getting less and less every single month, every single year. And that's therefore deemed as being more realistic. So businesses have to choose whether they're using the diminishing balance, which will show a more realistic value in your books, or the cost method. The cost method has got tax advantages. Because other than year 1, when you wrote off 20,000 in both methods, if you look here, year 2, you'd write off 20,000. In year 4, you'd write off another 20,000. Whereas in year 4, you would only write off 10,240 under this method, which is about half of what you do on the cost. Now, depreciation as a cost, as an expense to the business, will have an effect on the final profit and therefore the tax benefit. So from a tax point of view, this is seen as the greatest benefit because you can write off the maximum amount and get the greatest tax benefit. SARS stipulates the amount, the maximum you can write off a year, and you get the greatest tax benefit. But under this method, your assets worth R1. It doesn't show your assets at a realistic figure, whereas this would show as a more realistic figure. Now at school level, you'll be told which method to use. What you've got to be able to do is know how to calculate using the different methods. And the only other thing to please watch out, if you're working with a financial year, let's say from the 1st of March to the 28th of February, and they tell you that you buy a new vehicle on the 1st of December, you've got to watch your depreciation. Let's say you had an asset for 200,000 here at the beginning of the year, and then you bought another 50,000. This 200,000 over here, and if I'm just going to go on the cost method here, times 20% would be for the full year, 40,000 Rand. Whereas this 50,000 you've only had December, January, February, so you'd have to have 50,000 times 20% times 3 over 12 months. 12 months in a year, but you've only had it for December, January, and February. So while it would come out with your depreciation over here at an amount of 2,500, because you work out 20%, which will be 10,000, but that's for the whole year. You'd have to divide it by 12, because it's 12 months in a year, times 3, and your depreciation would be 2,500. And so your total depreciation would be 42,500. You need to watch your dates very carefully and take note that because you bought it on the 1st of December, you've had this for the whole month of December. A lot of learners don't know whether to include or not to include December. And that's where a timeline helps you. It's going from the 1st of December to the 28th of February. So the whole of December, January, February are included. So watch out for this, and obviously it can apply in either diminishing balance or the book value method, or the other method being the cost method. So make sure you understand how to use the two different methods, and watch out for pro rata or for a number of months in a year. Good luck.